Hey everyone, in this video I've got one growth stock that's down almost 70% off its highs that I think you might regret not buying on the dip. So before I reveal what that growth stock is, I'll talk about its revenue, its cash flow, and its valuation before revealing what the growth stock is towards the end of the video. So let's get right into it here, starting with its revenue growth. And you can see here from January 2021 up until its most recent update around April of 2023, this company has more than doubled its revenue from around 300 million to 614 million. Now, I will say that this company is running a long-running tailwind. It's benefiting from a long-running tailwind that should continue to support its growth for several years into the future. More impressively than the company's revenue growth is how it's turning that revenue into cash flow. What I have here is a chart of its cash flow from operations to sales over the trailing 12-month period. And what you could see from that same time, January of 2021 till about April of 2023, the company has increased its cash flow from operations to sales from around 18% all the way up to 32.72%. So not only is the number solid, 32.72% of sales turning into cash flow from operations is excellent, to be sure, but I also like the trend that it continues improving this number, meaning that it's demonstrating to me that it benefits from economies in scale. As revenue grows, it turns more of that revenue into cash flow from operations. How does it do that? Well, I'll give you just one example. If a company, let's say, spends $10 million on its corporate headquarters, its offices, that number is likely fixed, right? So it's probably signed that lease for a 5-year term, or maybe it owns the building and it expenses 10 million per year, whatever the case might be, right? Let's just round it nicely to 10 million. That cost stays the same, 10 million every single year. But what changes is the revenue grows. So as the company grows its revenue, the cost stays the same, revenue keeps growing, and you see a bigger and bigger gap between revenue and costs, which leaves more to profits and cash flow. So that's one example of how a company demonstrates economies in scale. Now, this could be risky in the other direction. If a company has those kinds of fixed costs and we go into a deep recession and revenue is falling and the costs are staying the same, now that leads to a greater and greater loss of profitability. But when a company is growing and it has the fixed costs, then it's a good sign it works out in its favor. So right now, this is working in this company's favor, and it has worked in this company's favor for several years now. Finally, the last reason I will highlight why I think you might regret buying this growth stock or not buying this growth stock is because of the relatively cheap valuation. This stock is trading at a forward price to earnings of just 18.24, which is an average valuation compared to the average stock in the S&P 500. But this is not an average stock. This stock is growing at a healthy rate, is generating very strong cash flow from operations. So in my opinion, I would be willing to pay a premium price for this stock, but I'm able to buy it at an average price. So in my opinion, it's a bargain. It's a bargain because you're paying a fair price for an excellent stock, which should be trading at a higher valuation, in my opinion. So for all those reasons, I think you might regret not buying this growth stock. So what is this growth stock? The name of this company is DigitalOcean Holdings, ticker symbol DOCN, DigitalOcean. Company's got good revenue growth, excellent cash flow from operations, trading at a bargain valuation. But that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.